Okay, wait, is it actually streaming now? Nice. Okay, let's see. I think today I'm just gonna go over some flashcards I'm with. I don't know, I'm streaming right now.
What?
I don't know how to turn the camera on though, so.
Why are you streaming?
Because I want to become a live streamer.
You're streaming your Anki practice, your 432 Anki practice. What is up, guys? Today we're gonna be studying.
Let's see, I don't know.
What is up, guys? Today we're gonna be studying gradient descent.
Yeah, I want to live stream my life. Yeah. Well, I'm just gonna see what happens. I'm just gonna live stream it. Yeah. Yeah, I wasn't talking. Yeah. That's the goal. That's the goal. Okay, wait. How do I actually wash this though? Okay, wait, this is going. Okay, wait. Videos, live. So if I go to YouTube. Oh, nice. Okay. So if I go to YouTube. Oh, nice. Okay.
I was like, you already went home then.
So if I go to
I thought
YouTube.
you went home.
Oh, nice. Okay.
I was like, you already went home then.
So if I go to
I thought
YouTube.
you went home.
Oh, nice. Okay.
I was like, you already went home then.
So if I go to
I thought
YouTube.
you went home.
Oh, nice. Okay. Alright, now how do I... Why is this so small though? Drop frame. Okay, if I remove that, Mac OS screen. Okay, wait. Oh, it's not big enough. Okay, it has to fit. Alright. Okay, let's see. This is actually look good now. Your channel. Oh, okay, nice. It's working. Okay. Let's study this. What is the intuition behind the trading strategy in homework 2, question 2? So for the trading strategy in homework 2, question 2, we looked at the relationship between trading short-term maturity bonds, rolling them over, versus just trying to ride the yield curve and kind of earning a higher interest rate on bonds by holding them into maturity. And it turns out, I don't know what the mathematical reason is, but if we buy and sell shorter term maturity bonds and we roll them over, let's say in 7 to 8 years, then with a constant yield curve, then that's actually a more profitable trading strategy than holding all of the bonds until maturity. Yeah, that's what is no amortization of principal. So that has to do with the concept of paying back loans. So when we have a loan, there's a principal component and there's also an interest component. And when we think about the amortization of principal, whenever we're paying back mortgages, we're usually paying back interest and principal at the same time, so that every payment is actually reducing the principal amount and therefore reducing the actual interest we're paying. Now, for, let's say, bonds, say government bonds or corporate bonds, there's no amortization of principal. The principal is always going to be paid out at the maturity of the bond. And instead, you'll get periodic interest payments from the coupons, let's say 6% a month, 6% a quarter, something like that. In a perfect universe where we don't have to think about taxes, assume a company issues a dividend at $1 and closes at $100. What is tomorrow's opening price? Why? So P claims that tomorrow the company will be priced at $99 after paying out the dividend of $1. And maybe behind that statement lies the fact that the market is currently valuing the company as paying out the $1 dividend. And so if the company does, then that value of the dollar is gone, and so maybe that gets removed from the price. Yeah. Let me flag this.
You guys find people take over your lease? Huh?
If two assets move independently of each other, what is their covariance? If two assets move independently of each other, their covariance is just 0. What percent was the stock market total market cap compared to the GDP in 1970? Maybe like 20-30% compared to GDP. 20%. I don't know. What is the correct underlying concept behind the time value of money? The correct underlying concept behind the time value of money is that the value of money changes over time. It's not necessarily the fact that you'll be able to, that money today is worth more than tomorrow because of the fact of real interest rates. It's a bad thing with points in time. Okay. What is high watermark? No idea what this is.
You don't know what applesauce is?
High watermark is the highest net asset value of the fund on which an incentive fee has been paid. This is the highest net asset value recorded on the incentive fee computation. Okay, I guess what this is saying is that when we have some type of investment fund, usually they have some sort of fee structure. That's a pretty good drawing of Ethan, though. That's just solid. Yeah. Huh? This is the highest net asset value recorded on the incentive fee computation dates. So the highest net asset value recorded on the incentive fee computation dates. Okay, so right, investment funds have different types of fee structures, and in order to actually calculate the fee on the net asset value or the assets under management, usually sometimes it's based off the high water mark, which is the actual net asset value or the highest net asset value of the fund on the date that the incentive fee or the asset under management fee is computed. UTC is coordinated universal time. It's briefly. Yeah. Universal time is the time zone in which all other time zones are based out of. So, I think this is the time zone that runs down Greenwich, UK. It's kind of in the middle of the earth. And when you look at different time systems, time zones, they all are offsets of coordinated universal time. And so this is pretty relevant because when we look at financial data, sometimes the dates don't match up and the time zones don't match up. And so we might have to do some pre-processing in order to actually match those time zones together. And serves as the basis for all the time zones. So the time zones be offset of these. Okay. Why would a fund invest in multiple types of hedge funds? For diversification. Control risk. Okay. If two assets tend to move in the same direction, do they have positive or negative covariance? Huh? Why? No. Alright, why'd you even ask me? Yeah, that's what I thought.
That's crazy.
We go up. There's no one watching, so.
I'll watch.
No, you won't.
I don't know how well you're streaming on.
Yeah, I can't even find it. I tried looking it up on my phone. It doesn't exist. If two assets tend to move in the same direction, do they have a positive or negative covariance? They should have a positive covariance because they are moving in the same direction. Okay. If two assets tend to move in opposite directions, then they have negative covariance. A single manager hedge fund is a hedge fund that invests in multiple types of asset classes: stocks, equities, debts, cash, fixed income, foreign exchange, real and financial assets. Okay. Single manager hedge fund invest in real and financial assets, not other hedge funds. Okay. 4 types of hedge fund strategies usually have things like global macro, relative value, event driven, maybe long short equity. Okay, never mind. So directional strategy, event risk, absolute return, diversified. Okay. Fund mortality. So fund mortality is the idea of how long can a fund actually exist. And this is pretty significant in 2010 because a lot of hedge funds at the time could only exist for 2-3 years before going under, usually due to loss of leverage. Okay. When does compounding really take into effect? So when we look at a graph of how much a dollar compounds versus just simple interest, the compounding doesn't really take into effect until later periods. Let's say 20-30 years after we receive our dollar.
What the fuck? That's so scary.
Nice for sipping.
That's hard to see how I look right now.
Jesus Christ. The future spot rate is the actual interest rate we receive on an instrument, or the actual interest rate for borrowing in the future. Sweet day. Lower than the rate that would cause investments in long term to have the same return as investments in so implied forward rates. And then rolling over to other notation. I'm really saying this actual interest rate is usually different from the implied forward rate in future market today. Okay. How much simple interest is earned if the annual interest R is equal to 6% and the investment period in years is M is equal to 2? Ooh. R is equal to 6%. So the total interest earned is going to be future value. So it'll be the principal or the amount today times 1 plus 6% times 2. So yeah, I guess it really depends on what our actual principal is. So linear plus interest figuring out the simple interest linear so we can just add the interest rates together. Okay. What is the significance of the R times M term when solving for the future value given the principal? So the significance of R times M is the total amount of simple interest that we've accrued over the life of, let's say, our fixed income security. Global macro funds are funds that invest in the entire economy and really take advantage of different types of asset classes, from foreign exchanges to foreign debt to equities and maybe some private equity stuff. Top-down managers who take a wide macroeconomic approach on a global basis in their investment strategy. These guys invest in different countries across different asset classes. Okay. So given the following, we have 3 dates, T0, T1, T2, and 2 maturities, M1 is equal to T0 plus T1, and M2 is equal to T1 plus T2. Term structure R for continuously compounded investments. What does the following expression represent? So R T0 M1 times M2 times M1 plus M2 is not equal ER. I see. Okay. So the following expression represents the fact that the future implied rate I guess you could call it the implied forward rate, does not necessarily hold in the sense that if we held a bond today for M1 plus M2 maturities, so from T0 to T2, then that it won't necessarily be the same as holding a bond from T0 to T1 and then selling that off, then buying another bond from T1 to T2. So the returns of those two strategies may not be the exact same. This is a longer term investment. The gross return on an investment that is continuously compounded for M1 years. Then rolled over to the shorter term investment. Let's continuously compounded for M2 years at a rate of RT1 M2 times M2. Okay. Yo. What do you think? Given the number of interest payments in a year N and the investment period in years M, how can you describe the relationship relationship M times N. So given the number of interest payments year N and the investment period year M, how can we describe the relationship M times N? So M is the number of investment periods. Okay, so in years, I guess. And N is the number of interest payments. So M times N is the total number of interest payments for our investment. 4 types of hedge fund strategies. I think you have directional strategies, event-driven, event risk strategies. I think absolute return, something else. Event risk, diversified strategy, okay. Event-driven strategy. So duration is kind of measured the present value weighted time until maturity. So what does that actually mean? I guess it depends on how we calculate it. And usually we take the present value of the cash flow at that time. And then also a corresponding maturity in which period in which the actual payment is paid out. And so what you have then is a dot product between vectors of cash flows and also vectors of maturities. And so the dot product between the two then is going to be your actual duration. Okay, but what does that actually mean? So I guess you can think it as the amount of time you would need to wait until you get the full amount of your cash flows, or I guess the present value. So it measures how sensitive your investment is to changes in interest rates. But I think it also measures the time until you have the present value equivalent of your bond today. Bless you. Time to maturity. Okay. Yeah, this is hard. High watermark. High watermark is the price of, I guess, the value of some type of investment fund at the date in which we actually it's the highest net asset value of the fund whenever we compute the incentive fee. Okay. Okay, that's good enough. Global macro funds are hedge funds that have strategies that try to encompass global macroeconomic activities. So they're investing in different types of countries, the infrastructure, the debts of different countries, and you're also investing in a wide range of asset classes. Okay, this one I'm just gonna skip for now. The implied forward rate is related to the yield curve, and so what the yield curve tells us, it will give us the corresponding interest rate for some type of investment, fixed income investment that we hold for a certain amount of time periods, let's say maturities. And so another word for the yield curve is the term structure of interest rates, because it's more of a function of two variables: the time today, which is constant, and then the maturity in the future. And usually with a yield curve, it's a monotonically increasing function in the sense that whatever input for maturity that you have, as the maturity gets higher, so will the yield curve. So the implied forward rate is the idea of no arbitrage. So if you were to have some type of bond and you held that for 5 years, then the term structure will give you a gross return or an interest rate that would give you the exact gross return on holding this bond for 5 years as holding the bond for 2 years, selling it, and then purchasing another bond at year 2 and then holding that for 3 years. So the implied forward rate will be the rates in 2 years for holding a 3-year maturity bond. That would equate your total gross return to be the same between two of the different strategies. Self-is interest rate on the second short-term maturity security. T0 M2 times M2. Mathematically, this looks like ER T0 M2 times gross return of second short-term security using implied forward rates. Be new, that's be new. Okay, nice. How do we mathematically describe the relationship between the long rate, the short rate, the implied future rates? Okay. T0, T1, T2 given, okay. So, I think under the expectations hypothesis, the long rates are T0 M1 plus M2 times M1 plus M2 is equal to the short rate plus the implied future rate. Okay, 3 and 30. 3 and 30 is just a way to describe a fee structure of a hedge fund. So I think it's 3% of assets and 30% of profits. What did George Soros speculate in the currency markets in the 1990s? Oh man. So I think what George Soros did was there was something going on in the UK, and George Soros ended up shorting a lot of British pounds, which drove and I think the currency was being devalued and he was able to profit off of it. And then days before the euro, the British pound was a member of the European exchange rate mechanism to keep currencies within a specified range of values relative to other European currencies. Marks. Relative to other European currencies. The pound did not deviate by much than 6% relative to its official rate, stated in terms of German Deutsche Marks. Purchased a pound if it fell below the 6% target rate. This ended up falling apart and the pound fell a lot. Okay, so this is something I might need to do more research on. Don't really remember what's going on here. Multiples expansion. So I hear this term a lot in the news. I guess finance news too. So according to some Axios article, multiples expansion is just a fancy way of saying that prices of different types of stocks or assets are going up just because they're going up. There really is no underlying change in the company valuation. It's just that the prices themselves are going up. That feels okay. What would the duration be for a 91-day Treasury security? So if we look at the duration for any type of fixed income security that doesn't pay out any coupons, Treasury security being one of them. Okay, not all Treasury securities, but Treasury bills being one of them. The duration is the exact same thing as the maturity. What is the effect of having more compounding periods to the yield to maturity? As you have more compounding periods, the yield to maturity is going to decrease. I got it.
You're at the end. Really sad.
Alright, why you guys stand up then? Stretch a little bit.
Maybe I should have taken them all. I should have taken that wall. So I get the door. Taking that wall to get the door.
It's okay.
You know, I'm always standing next to you today.
Nice. Oh yeah, can you do it? Hey.
Wait, the Jungkook.
Standing next to you. Well, wait, you should play it on here.
Elliot literally knows the fuck we're talking about. Really?
Keva learns standing next to you, and I'm gonna see it live.
Jungle Cock.
The band version. Oh, what the fuck? What is the effect of having more compounding periods to the yield to maturity? So if you have more compounding periods, then that means the yield to maturity should decrease.
Yeah, I do have to put the mic down. Wait, I'll do it for like.
Because the effects of compounding does a little bit more work for you. Increases. To maturity decreases. No, I'm good.
I brought my whole ass kettle here.
You brought your kettle here? Damn.
I'm serious about tea.
Yeah, that's pretty sick.
I told her about tea club. She's like, I'll go to this.
Ooh.
No! I never heard of this. Eric? Yeah. Eric who?
I feel like we're animals and they're just looking at us at a zoo. 4 types of hedge fund strategies. You have your event risk, diversified, directional, and absolute return. In practice, what are ways to think about duration, according to Pete? It's a measure of how sensitive fixed income securities are to interest rates, I think. Oh, what was the thing about duration? So there's the theoretically correct way based on a correct yield curve. and the approximation based on the yield to maturity. Okay, so I guess what he means by this is that when we calculate the weights, we're actually calculating the present value of the cash flow at that time. So the theoretically correct way is
Something perfectly innocent.
we should have a yield curve that will tell us the exact amount of interest we receive in the future. And I guess the theoretically correct yield curve would be a yield curve that doesn't changes. So then we would discount our cash flow by the correct interest rate at each payment. But most of the time we don't have a perfect yield curve, and so we approximate it by discounting by the yield to maturity. Hey, hit it, Kava.
I don't know this part.
This isn't the. Oh, this is not the chorus. Okay.
He just started. I did the dance break.
It's just the maturity. It's okay.
I'll throw out some basketball.
This is you?
Make a
Hey.
I don't know this part.
What's up?
Oh, yeah.
I'll do it later. Which is never.
Fuck you.
Yeah. Oh, is this it?
No.
Oh, this is it.
No.
Oh, shit.
It doesn't start till like here. That's totally good. Yeah. Oh, this part? It's stand. It's like this, and then here it's I don't know. Yeah. It's like the part where it's like. I can't do it places though. Not with.
Wait, Ethan, did you make a star?
Yeah.
Fuck.
Peer pressure.
If Ethan made one, that means I definitely do not need to make one.
You know how to make one?
I have no idea how to, anyways.
Then we'll show you.
It's okay. Yeah, I'm good.
It's so epic.
It's so fun.
And then next to you.
That was
and then
part
next to
yet?
you. Oh, that was it?
No.
I saw
That's
John.
part of maybe the first
Okay, I need to learn it.
Alright, ready? Wait, this part. Or in a couple seconds.
Okay. Next to
Oh
you.
wait, I forgot there's people.
That's okay, they can't see. Hey. Then next to you. Hey. I feel the ground shaking. That shit was crazy. Let's go.
And then they just do like a.
Yeah, let's go.
Cover drop soon. Kidding, I don't know when.
What's up with the Black Mamba thing?
What do you mean? What do you
I'm so
mean?
confused.
Black Mamba.
What do you mean?
What do you,
What's up with Black Mamba?
what do you mean? What's up with Black Mamba?
Wait, can I play a song with you?
Yeah.
Or I'll cue up a song. Yeah, I'm thinking this is the weirdest match I've ever
I know, I hate it.
It's like one of those weird ones, you know?
No, it's like the, temperature one.
Oh, temperature.
my god, this song is so old. Holy shit. What? Oh, you know money? Bunos. Edamame.
I want to play. They are not.
He's not like the other girls. It's Baby Gravy now? I thought it was Young Gravy.
Oh yeah, Baby Gravy is Baby No Money and Young Gravy.
Ah. It's a fucked up name, but whatever. Let me name it this slur.
What's what?
Vasectomy.
I mean, it is Baby Gravy. It makes sense to have the opposite, I guess.
It's this one.
No.
Huh? This one?
I guess the opposite is like first. I like enough.
There's also a new one. Yeah, no, me neither.
You wait.
Yeah, he sounds black.
No?
Yeah.
No, does not sound black. What do you mean?
SOS. That's the crazy mushroom frenzy.
Dolly Parton.
Dolls kill.
Bro's just cooking at this point.
Ugh. Yeah. As the standard deviation of returns increase for the Sharpe ratio, then our Sharpe ratio decreases. And this illustrates the normalization of risk is because we're dividing by or scaling by the standard deviation of returns, which a lot of people use as a measure of risk. So it's the volatility of our returns. And so the Sharpe ratio then is a risk-adjusted measure of the excess returns of some type of asset or portfolio. Smaller Sharpe ratio. Global macro funds are hedge funds that are invested in more worldwide global views, different countries, and also different types of asset classes. Top-down managers. Okay, so top-down, I think you look at the different asset classes you invest in. Bottom-up is different types of securities. What did George Soros speculate in the currency markets? So there was something about the European Union having some type of control over the fluctuation of the British pound versus the German Deutsche Mark. And so I think it was a 6% rate. Goodness gracious, Tito's got me beyond fucked up. It's ostentatious. Fucked up. Fucked up.
Oh yeah, me and Francis have talked about
that. Okay. Oh, the British pound is a member of the European Exchange Rate Mechanism, which sought to keep currencies within a specified range of values relative to other European currencies. The pound will not deviate by more than 6% relative to its official rate stated in terms of German Deutsche Marks. The British government would purchase the pound if the £20 fell a lot. Okay. Duration is the present value weighted time until maturity, average time until maturity. Divided by even though Brownian motion process usually starts at 0, what is the more common starting value of a Brownian motion process for a stock price / stock return? So a Brownian motion process is just some stochastic process that measures something happening over a course of time. Usually, the Brownian motion process starts at 0, and then the increments are normally distributed with some type of volatility, variance, or standard deviation. Now, when we're actually modeling stock prices or stock returns, common starting value of Brownian motion process is just the actual stock price itself. Natural log, which is often the log or natural log price. What is each realization of a Brownian motion process? It's just the sample path of a Brownian motion process. And what does it mean when modeling asset prices? It's just to show what's possible outcome of this random process will, and it comes to the actual asset price. Possible fluctuation of prices over time. Yes. Wait, Ethan, do you know what this guy's saying?
No.
Yeah, me
I don't-
neither.
It sounds like he's speaking Chinese. But
Yeah, but yeah, I have no idea what he's saying in Chinese.
It's fun out. 有2条牛仔裤让他特别纠结，问我哪条好看，我都全部带走，不看表盘，搞起打包，最后一块蛋糕我们一人一口，都想让我跳水，从头摸到嘴。Yes, that's a rhyme right there. 丢了一件小衣服给他，被他们收湿碎。你干嘛要干？舞台被我支配，以10分钟之内取得了王朝。当明星的滋味，数字不断上升，像按键算器，按计算器，靠卖保险媒体成功的案例，把 Melody 科技机。看我的兄弟，我们在泰国基尼，我们都是行走的提款机。
Wait, SOS, IVMC, you go to dance.
不能喝打车回家。
So if you don't see the lyrics, you know what he's saying?
No.
Okay.
Well, also it's a tonal language, so if you sing a tonal language, it makes it very hard to understand.
Is English not a tonal language?
English is not a tonal language.
What are some, is Vietnamese a tonal language?
Yes.
Okay.
Vietnamese, Thai are both tonal languages.
Okay. So it depends on how you say it.
Yeah.
Dun, 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 dun. How can we derive the discount factor using simple interest? So the discount factor is just the present value of $1 after some period of time. So the discount factor then, using simple interest, is just 1 over 1 plus r times n. MMS periods there. Substitute the future value PF is equal to 1. Discount factor. Okay. In general, is the return from rolling over short-term maturities different from returns on long-term investments? Actually, no, they are different. So there's this concept of implied forward rates, or the expectations hypothesis, which suggests that the returns should be the same, but in reality, things change. Inflation, economic downturns, or economic prosperity, they all have different effects on the yield curve. And so, usually short-term maturities, rolling over short-term maturities will offer different returns compared to longer-term investments. Okay. Co-investments. Don't know what this is. Co-investments allow institutions to invest alongside a private equity fund. Okay, to assume control of some company. This reduces fees that originate from directly investing through the private equity fund. Okay, so I guess you're investing along. You're investing along with a private equity fund. You're not actually directly investing into a fund, but maybe just a specific company or asset that private equity fund is investing in. The log volatility of a geometric Brownian process. So I think this might be. Oh man, this. I don't feel like I remember this one. Okay. So, the geometric Brownian process is just the Brownian motion process, but exponentiated to the e. So when we work with exponents, then we have e raised, let's say p minus, maybe p1 over p. Oh shoot. Standard deviation of log given h1. So standard deviation of the log of p of t plus delta t over p of t is the value of our geometric Brownian motion process, which is equal to sigma. And you'll double check. Square root of delta t. That's the standard deviation of the log of p over p is equal to, okay. Alright, I have to go use the bathroom now. Wait, can you scroll up, Tiffany? A little bit further. A little bit up. Every Last Drop? That's a crazy album cover. I have no idea who that is. That's sick. Yeah. Freak is the number of compounding periods in a year. Ooh, so when the number of the frequency of compounding. So 1 over freak. I think maybe compound interest actually has a less return than simple interest because let's say you have half of a compounding period in a year then, or maybe your investment compounds in every 2 or 3 years, then this kind of blows up and simple interest should earn more. Okay, this one's hard, yeah. So, as the standard deviation returns increases for the Sharpe ratio, then the overall Sharpe ratio decreases. And this illustrates the normalization of risk because the Sharpe ratio is a risk-adjusted measure of excess returns. And in our denominator, we divide by the standard deviation returns, which is supposed to adjust for the risk by kind of scaling the excess returns. So I think the European rate control the European rate control is able to European rate control, I think, was tasked to control the percentage of the rise in the British pound compared to the German Deutsche Mark. But that ended up falling apart, and George Soros made that prediction, I think. So, thanks for that. European exchange rate mechanism. Yeah. Co-investments are investments that can be made along with private equity firms where you're investing in a company or some type of asset, but you're not actually investing through the private equity fund directly. What does an increment represent in a Brownian motion process? What does it represent when modeling asset prices? So an increment just represents some movements of an object along this process. And when representing asset prices, this is just the change in price over time. If we are modeling asset prices, the increments. Yeah. Whenever you want to. What do you think? fund of funds is an investment fund that invests in other funds. Hey, I like the flash.
I still got 6 years. I haven't even gotten to like my actual schoolwork.
Is there a lot of stuff?
Not really. I just have 2 exams. I'm just like doing a little bit more.
God damn. Duration of a coupon bond is less than its maturity. Oh yeah. Alright, I'll just go get it right now before I forget. I bought Sweetgreen earlier, and I left it in the fridge upstairs.
Or like peanut noodles.
It smells kind of weird. I don't know what happened. Huh? What? That's nice. Can you go back to one second? The duration of a coupon bond is less than its maturity. So the reason is because the actual present value relative to the present value. Oh, okay. I think this has to do with the fact that cash flows in the beginning of the period are weighted more compared to cash flows in the end of the period. So when you have a coupon bond, then the present value of those cash flows will decrease. Present value of those cash flows relative to the total present value of the bond will decrease. For or on maturity dates. Okay. The log volatility of geometric Brownian motion process is just a standard deviation of the log of the returns from the geometric Brownian motion from t to delta t divided by the returns of the geometric Brownian motion process. And then that actually is just equal to sigma, which is, I think, the standard deviation of returns, and we multiply that by square root of delta t. Log volatility. What is the relationship between compound and simple interest when 1 over free is greater than m? The frequency is the number of compounding periods in a year. M is the maturity in years. So when compound and simple interest, when 1 over frequency is greater than m, the frequency is the number of compounding periods in a year. Right, so we calculate compound interest by dividing our annual interest by the number of times we compound per year. So it's r divided by n, r divided by frequency. And then we then add 1, and then compound it by frequency times n, which is the number of maturity in years. So if we reduce our frequency, then say 0.5. This keeps it. We get a really large number in our denominator, and a small number in our denominator, and then the actual interest kind of blows up. Then we compounded by less than. Yeah, this is tough.
Wait, you guys can meet up at lunch to get a haircut?
Sorry, bro. Time zone.
Yeah, when you pass by on the side. Wait, what?
Yeah.
Those are people.
Yes. Have you been
It's
to
crazy.
the Dominican Republic?
I got this.
Yeah, definitely did not go. Wait, who were you with?
See.
Wait, who did you been? Oh.
And I met her when we went to like
This. Alright.
Okay.
Why is the largest representable 32-bit integer equal to 2 to raise to the 32 minus 1, not 2 to the 32? I think because we need the 0, the number 0, so we just have to subtract 1 from 2 to the 32 to represent the 0. Unsigned, right? Okay. Maybe unsigned integer. So, what does the del factor square root delta t represent in the log volatility? Sigma times square root delta t of a geometric Brownian motion process. So this is going to be the square root of the amount of time that's passed by. And so the variance of returns is actually in terms of years. And so it's the same amount of units as the asset returns. But when we take the volatility, we have to take the square root of that in order to get the square root of the delta t. Okay. The Brownian motion sample path is just a realization of the Brownian motion process. It's a function of the continuous variable t itself is a continuous function. Okay, I didn't really get that. What is the risk aversion parameter rho? What happens when rho is equal to 1? Rho is greater than 1, rho is less than 1. So I think when we think about portfolio theory and we think about constructing a portfolio with risky assets, then rho is a parameter we can introduce when calculating, I think, our expected return and our variance of returns, which measures how much risk an investor is willing to take. So with rho is equal to 1, then Pete says the investor has something called log utility. And if rho is greater than 1, then an investor is more risk averse. So they're less willing to take on more risk. And if rho is less than 1, then the investor is less willing to take risk. Optimal portfolio. What is an intuitive way to generalize the demand function for a portfolio that invests alpha in a risky asset and 1 minus alpha in a risk-free asset? The demand function for a portfolio that invests alpha in a risky asset, 1 minus alpha in a risk-free asset. So a portfolio has 2 assets, 1 in a risky asset, 1 in a risk-free asset. Then the demand for the risky asset for, I think, a growth optimal portfolio. So that means rho is equal to 1. It's just equal to pi over sigma. So pi being the excess return of our risky asset and sigma being the standard deviation of returns. Oh, okay. So risk aversion parameter. Ooh. So we pi over the volatility squared. What are some potential problems with ticker symbols and ways to combat them in a data analysis context? So Pete mentioned in class that one of the ways that ticker symbols might cause problems is when a company gets delisted on exchange and then another company that gets listed on exchange reuses the same ticker symbol, and so then you actually have two different companies with the same ticker symbol at two different times. Maybe then you can add the time, combine the time and the ticker symbol, and then that will give you some type of unique primary key. Dates are stored in Unix as the amount of time has passed. I think the amount of seconds has passed since January 1st, 1970, according to Universal Time. So exactly at 12 a.m. Geometric Brownian motion is the idea of Brownian motion, except it's exponentiated. So it's e to the power of a Brownian motion process, to the value of a Brownian motion. Value of a Brownian motion process. Okay. What do economists assume that investors try to maximize? Economists assume that investors try to maximize utility. And utility is the idea of happiness or utils, or maybe benefits. The way they say this is they try to achieve the highest amount of return while staying within their risk appetite. Intuitive way to think about risk aversion for investors. I'm not too sure what I actually mean by this one, actually, but I think one way to think about risk aversion is that investors would rather not lose money than earn a lot of money. Okay, investors prefer higher means and lower variance on portfolio returns. Economists use the concept of expected utility to model the trade-off between return and risk. Higher means, lower variance on portfolio returns. The concept. Okay, I can't drink this shit anymore. Higher means and lower variance on portfolio returns. Okay. Along with the home, what do homeowners also receive when they buy a house? Surprisingly, they also get the land of the house. Can we derive market interest rates yields from discount factors? So for market interest rates or yields, the discount factor, I think there is a way to derive them in the sense that the discount factor is just a present value of a dollar that's received in some period. We'll call it M. And so the discount factor is, depending on the type of interest or compounding convention we're using, it'll be 1 over, let's say, simple interest 1 plus r times m. And r is the market interest rate that we can derive from the discount factor for holding a fixed income security now until the maturity date, or when we receive our dollar. Okay. So Pete ran an experiment with, I think, these calculators that would calculate whether or not it's beneficial to rent versus buy a house. And he found that you would actually, most calculators told you to buy a house, even though that wasn't the best idea. And the reason is, a lot of these calculators were sponsored by realtors, and so because of that, then because of that, I think a lot of these calculators were more biased towards trying to get people to buy actual houses. What are 2 advantages of geometric Brownian motion over Brownian motion? So I know one advantage is that prices never go below negative. Also, maybe log volatility just doesn't depend on t, but it depends on sigma. Both log volatility defined as a standard deviation of log p of t plus delta t. Percentage volatility defined as c constants which do not depend on t or p of t. Oops. Okay. How does perform more to less in risk aversion affect the utility function? Expected utility for investors. So the expected utility of the utility function is it'll map some wealth to, I guess it'll map the amount of wealth to the utility for that amount of wealth. And so there's different ways to express utility functions. So I think power utility, squared utility. The most common one though is log utility. That represents kind of this logarithmic function that's monotonically increasing but also concave. And the reason is because of this more to less, you would want a function to be monotonically increasing, but investors are also risk averse, so you want your function to be concave. If interest rates and discount factors represent the same thing, why do we need both? So discount factors are represented as prices, versus interest rates are measured as percentage rates over time. And so both of them can be used for different types of situations. It's useful. Model finance. Quota modeling. Okay. What are 2 important properties of a Brownian motion process? So Brownian motion process, 2 important properties is that the increments of a Brownian motion process are normally distributed. I believe it's a standard normal distribution with a mean of 0. Actually, it's just a normal distribution with a mean of 0, but it has some sort of standard deviation sigma. That's one important property. I think the second one is that are independently distributed. Same as this is equal to sigma squared plus delta t. One in a billion. because you're laughing at me, bro. You ain't gotta. Is this the stat thing? Oh fuck. Good love, we did not learn about gamma or hyper.
What? How? What fucking stat verse do you have?
This guy named Latoka.
Oh, okay. But I guess it's
Neg binom? Yeah, we didn't learn about that.
wow.
Covariance, okay. Ding, 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 ding. Are independently distributed from the history of the process up to the date C. Are independently distributed from the history process up to dates. Are independently distributed. They are independently distributed because delta T changes. Okay. So should be due to delta T change. This should be due to delta T changing the variance of the distribution for non-overlapping time. So the distribution for non-overlapping times. Okay. What does the square root of delta T represent in the log volatility equal sigma times square root of delta T of a geometric Brownian motion process? So this should represent some type of time interval, and square root of delta T is okay. So for the Brownian motion process, we defined the variance or the standard deviation as sigma squared. Describe the increments as having as being normally distributed with the mean of 0, the variance of sigma squared times
Brent had his
delta T.
412 exam today at 8 a.m.
Sigma
He was like, you
times
know, if I pass, I'll
delta
never
T.
have
You know what? You know so funny. I didn't even see anything for
What?
I didn't see
It's not that
414. Like,
What is the log volatility of a geometric Brownian motions?
Because I'm already taking AMS and 416.
The log volatility of a geometric Brownian motion process is just the
That's 35. Easy, relatively.
shit. volatility of a geometric Brownian motion process, log volatility is going to be the sigma times square root of delta t, which is a standard deviation of the value of a geometric Brownian motion process at delta t versus divided by the value of a geometric Brownian motion process at time t.
Yeah, but 1 over n is that sample mean. The 1 over n is the same thing over n to the top.
Yeah.
Right, but we have to get n over sample mean as the sample total.
No. This is the estimator for the geometrical Brownian reference.
No, I know.
So the sample
You've lost it. The likelihood of conflict
Plus delta t, PAT, minus log PAT increments of the Brownian is incremented. Okay, log of volatility. Okay. What is an intuitive way to generalize the demand function? So for a portfolio that invests alpha in a risky asset and 1 minus alpha in a risk-free asset. So portfolio that invests alpha in a risky asset and 1 minus alpha in a risk-free asset. So for a function that has a portfolio that has 2 assets, one risky, one risk-free, then the demand function can be thought of as, I believe it's going to be the excess return of the risky asset divided by rho times sigma squared, which is the standard deviation of returns squared.
Yo, it goes all the way to the fucking wall over there.
Okay. What is geometric Brownian motion? Geometric Brownian motion is just straight up a Brownian motion process, except we exponentiate the value of a Brownian motion process at time t. Oh shit. Time t is pt is equal to ept. So pretty much is the exponentiation of the value of a Brownian motion process. Pt is the value, pt is exponentiation of the value of a Brownian motion process. Okay. What do economists assume that investors try to maximize? Economists assumes that investors try to maximize the expected utility of their wealth, which helps model the idea of risk aversion. So, their wealth. Another way to say this is they try to achieve the highest amount of return while staying there within their risk appetite. Okay? What is an intuitive way to think about risk aversion for investors? So investors prefer higher means and lower variance, meaning that they prefer more to less, but they also are risk averse. So they prefer higher means, higher returns, at a lower variance, less risk. I'll trade off return. Okay, sweet. What are the advantages of geometric Brownian motion over Brownian motion? So geometric Brownian motion, the prices of the assets never go below 0, but also two advantages of Brownian motion. Okay, so I got distracted. Geometric Brownian motion is just the exponentiated version of the Brownian motion. But an advantage of that is once we exponentiate the Brownian emission value, then we'll never actually have a negative asset price. And also, the log volatility or the percentage volatility, which is standard deviation of P of t or delta t over P of t, that's log volatility, versus the percentage volatility, which is P of delta t minus P of t over P of t. So these actually don't depend on any parameter t, so these are just constants that depend on the actual underlying standard deviation of volatility of the returns. Okay. Ooh, so the components of R-bar. I feel like R-bar is used in the Gordon growth model, and R-bar is just measured as the expected return of some type of asset, risky asset. So this is composed of our risk-free rate and also a risk premium. Gordon growth model. Keeping the basics. Is that Lego Fortnite?
I don't even know how I'm even doing.
Expected turn on. In the Gordon growth model, what are variables that can be considered subjective? I think one can be the required risk premium, or I guess you could call it the risk premium or excess return of the risk-free asset, the risky asset. So that is the pi in our R-bar. And also probably the growth rate of our dividends. So the growth rate of our dividends is also considered to be subjective because there really is no objective way to approximate or to actually calculate what G is. It's really based on some internal biases and views on the market and the company. Discrete upon by investors. Okay.
What the fuck? Someone donated a subway sign?
Hey.
As a Tostido, sacrifice?
Alright, why does your Reddit look like that, by the way?
Why does my Reddit look like what?
Like it's some weird 2000s type.
Because I prefer old Reddit, because I've been using Reddit for 7 years and I started using it.
So this is the old UI?
This is the original UI, yeah. Bro, this shit looks photoshopped in, isn't it?
Yeah, no, I feel like it is.
No, it's not. It's real. It's real. If you look closely, it would make sense.
Yeah. Why is this shit so bright? And where the fuck is
Yeah, where's the power source?
Yeah.
Oh, wait, the guy who brought it over said that they took an extension cord to the exterior outlet of McKeldin. That's how they got it to work. Someone sacrificed the subway sign from the old subway that closed down. Because I guess you know how when restaurants close they sell their shit, right?
Somewhere the sandwich shop.
No, someone stole an entire metro train.
That's why I was confused.
Yeah.
What old somewhere?
No, because you know how Hanami, someone bought the sign.
Really?
Yeah, I saw them. No, we saw them.
Yeah, Nolan?
Yeah.
Nolan Vo?
Yeah, he bought it.
Why?
I don't know. The percentage volatility of geometric Brownian emission process. What? Huh? No. Alright, give me my earmuffs back. Huh?
Why's your head so pointy?
I was just born with a gift, I guess. Percentage volatility of a geometric Brownian motion process is
This looks like the cute map. Like how he has a big ass palm.
I think it's P of delta t minus P of t divided by P of t. And maybe you take the log of that and then find the standard deviation. Oh no, you don't. Oh man. Standard deviation of P of t. So this actually comes out to e raised to the u times delta t times square root of e to sigma squared. Oh man, this formula is pretty hard. What are the two important properties of a Brownian motion process? One, that its increments are normally distributed with a mean of 0, but also with a variance of sigma squared delta times delta t. And then also the different sample paths are uncorrelated, or they're independently distributed whenever they're not overlapping each other. So when the delta t is the same, then they're not the same. But when they are overlapped, then I think this has to do with the fact that delta t changes as time changes, right? And so when you're looking at overlapping periods, then your delta t is the same, so your variance is the same, and therefore the actual distribution that you're sampling from for the Brownian motion process is the same. It's sigma squared. So sigma squared is a constant since the history of the process of the supplies that. Okay. What does the factor delta t represent in the log volatility? So this is just of a geometric Brownian motion process. Some time factor to represent the change in time. And so your volatility is scaled by the square root of the change in time. Okay. Units. So interest rates are usually expressed in units of per year or like per time. Units of time, dollars, or no units of all. Okay. If interest rates are positive, how can you describe the function df t0 and discount factor, given the date today, t0, and the maturity in the future n? So if interest rates are positive, then the discount factor is going to be some number between 0 and 1, I feel like. The reason is the discount factor is just the present value of a dollar. And if interest rates are positive, that means a dollar today is worth less than a dollar in the future. Is worth more than a dollar in the future. The reason being is because you can invest your dollar today at the risk-free rate and earn some type of interest. Therefore, the present value of a dollar at any time in the future is going to be less than 1. Okay, so I described it as a monotonically decreasing function as maturity m increases. What is this sigma squared constant called when observing the variance of the increments to the Brownian motion process? Bt plus b. Ooh, okay. I think the variance is called, I forgot what it's called. The instantaneous variance and its constant changes in t have no effect on delta t on sigma squared. Okay. The instantaneous variance. The purpose of geometric Brownian motion is it's really the exact same thing as Brownian motion, but comes with some better constraints when modeling stock prices or asset prices. But it's just another way to model a random process. In this case, we're modeling stock prices or asset prices. Stochastic random process. What bias do the calculators have? Pete's housing lecture. In the Gordon growth formula, so R bar is the expected return on the risky asset that we're trying to evaluate. So for an investment to the asset, that this might be the required rate of return that investors would expect to actually invest or some firm that is
Don't you tell me that it wasn't meant to be.
maybe issuing the equity.
Call it quits, call it destiny.
Okay, so R bar, the firm issuing equity.
Because it won't come easily. Doesn't mean you shouldn't try. We had a good plan.
I guess so. With the firm issuing equity, they're on the receiving end of the cash flows rate. So maybe the Gordon growth model or Gordon growth formula is used to measure. It's used to measure the cash flows generated from some projects, or maybe
We're all in a building that I'm in almost every day.
the cash flows generated from for issuing equity. I'm not too sure exactly what that means actually, but I would think that this is their cost of capital. So how much they would,
Oh my god, my hair.
the cost of
falls into
capital
the
being an
toilet bowl.
opportunity cost, and how much they would expect to receive
How does that work?
on this investment. Cost of capital. This return firm is expected to generate using the funds in this reason.
Rapunzel type meat.
So this is the return firm is expected to generate using the funds as raised from issuing stock.
So want to stay here for a little bit or?
That's alright with me. Don't you tell me that it wasn't meant to be.
Are you gonna stay here too, Ethan?
Probably. Until I finish my job.
Yeah.
Just because it won't come easily. Doesn't mean we shouldn't try. Just because it won't come easily. Doesn't mean we shouldn't try.
Generate funds as raised from using stock. Okay. What is percentage volatility of the geometric Brownian motion process? Okay. And how many flashcards do we have left?
Just because it won't come easily. Doesn't mean
Oh, not bad. There's not that many left, actually. Okay. Percentage volatility of the geometric Brownian motion process is defined as
we shouldn't try.
the standard deviation of P of delta T. I don't know, it's just P of delta T minus P of T divided by P of T, which is equal to E raised to the U, which is the mean of our distribution, times delta T. And then we multiply that again by E to the I think sigma squared times square root of delta t. Square root of e raised to the sigma squared times delta t minus 1. Deviation are given. Okay. What do the numerators of ratio-based performance measures usually represent? Some type of return, excess return, on some type of asset. Return minus benchmark rate versus rate. For the return of a given, same thing as average historical return. This usually comes in the forms of, okay. Oh me, oh my. So the term hedge fund originated from Jones Fund. I believe it was the first hedge fund that incorporated a long-short strategy. Maybe 1951? 1949, okay. Jensen's alpha. So Jensen's alpha is a measure of performance on some type of, I guess, portfolio or asset in excess of, we'll call it the market portfolio, and also the risk-free rate. And so usually we can model some type of asset return as alpha plus beta times the return of the market minus the risk-free rate, and you add the risk-free rate. So this beta term is measuring the correlation covariance between the return of our asset versus the market, and the market being the excess return of the market portfolio compared to the risk-free rate. And so we can see that this beta times RM term and also the risk-free rate determines some of the actual returns that are generated from an asset. But then there's this third term which explains all of the other returns that the other two terms can't explain. So that's Jensen's alpha. And this kind of is like the, how much did our asset do better than the market and the risk-free rate. Compared to the market and risk-free assets. How is datetime stored in NumPy? Datetime stored in NumPy, I think, is the number of time, the amount of time that is passed. Datetime is stored as number of seconds has passed since the number of seconds that has passed since the epoch of January 1st, 1970, 12 o'clock a.m. according to Universal Time. What is the variance of the increments proportional to? What is the variance of the increments proportional to in a Brownian motion process? I feel like in a Brownian motion process, the variance, the increments. Oh, it's directly proportional to the amount of time that has passed, because the variance is sigma squared times t. So as t has passed, every increase in t will also increase the variance as well. It's proportional to delta t. This means as time goes on, the variance of the Brownian motion increment gets higher. You can see this in the following graph, whereas the more time passes, the variance volatility of the increment b t plus delta t minus b increases. You can see this in the following graph, whereas the more time passes, the variance is directly proportional to delta t. This means as time goes on, the variance of the Brownian motion increment gets higher. You can see this in the following graph, whereas the time passes, you need to increase. So insert picture of graph here.
Is that your photo?
Yeah. It's me
Okay.
pouring NyQuil on the right.
Whoa.
I mean, my roommate is
The two components of a stock return usually come from the capital gains and also the returns from dividends. How does a discount factor using a simple interest value $1 compare to discount factors using compounding or discount rate conventions?
Wait, how does
So discount factor
Wait, what?
using
Oh, it's
some-
an alphabetical order? How do I do it by adding? Oh, I can't. It's not me.
Okay. So I think discount.
The meat is raw. We're not cooking right now.
What does that mean?
The food
I have to
is
look it
raw.
up.
The food is uncut.
Well, I can't look it up. Bro.
Discount factor using simple interest value and compared to discount factors using compounding or discount rate conventions. So discount factor using simple interest value $1. I would say more
That makes
compared to a discount factor using compounding conventions.
Oh.
If the actual investment compounds more than, let's say, twice a year.
Fuck.
Now with discount rate
It will work.
conventions,
It will work. Where do you see? How do you see the cube?
Dude, that was already in my playlist too. So you could pick all
I think
that.
with discount
Oh, I
rate
just read the cue.
conventions,
Oh, did I? Yeah.
But that's your cue.
Oh,
But we were playing it.
unfortunate.
discount rate conventions. Oh man. Okay, so discount rates are interest rates that would
Me neither.
interest rates that you can multiply, I think, to the future value. Oh, maybe it'll be the future value times 1 minus the discount
1,800
rates
songs.
is equal to the present value. So
Yachts, damn.
it's how much you would
You was wrong.
have to find the
My truth.
future
I
value.
live
Which is
correct.
wrong.
I feel like maybe the discount rate would be the same as the simple interest rate.
Aw.
You wouldn't understand.
Should know that generally simple interest discount factor or value $1.
Me now?
Price is greater compared to discount factors
Why?
using compounding.
By
Discount
from
rates.
is 9.
From is 9.
The only case where
From
This
is
is-
underscore
From
9.
is underscore 9.
the number of compounding periods is greater than the investment periods, you need to check. The reason why is because the simple interest RT0T.
Oh, wait, listen to this shit.
Can I get a little skip here?
Love me
Is
back.
unsure
I
is
wanna
when
stop
the
not queuing. Like,
compounding interest is greater than the investment periods.
I love chaos.
So let's work. Compounding discount rates. Okay. Yeah, it's something I have to get back to. So, what is the percentage volatility of the geometric Brownian motion process? So, geometric Brownian motion process,
Reggaeton champagne.
it's equal to the standard deviation of P of delta T
Who messaged me?
minus P of T over capital P of T. So it's the value of standard deviation of value at delta T minus value at delta T minus value at T divided by value at T. And then that's actually equal to E raised to the U times delta T. E raised to the value of U times delta T, and then multiply by E times the square root of 2 times sigma squared. and then we subtract 1. Times E sigma squared times. Yo! What is the sigma squared constant called when observing the variance of the increments to the Brownian motion process? B of t plus delta t minus b of t. This is the instantaneous variance of the Brownian motion process. And doesn't depend on t or delta t or right. So constant changes in t have no effect on delta t. Okay. In the Gordon growth formula, how is R bar interpreted by a investor? So the required expected rate of expected return on an asset. Firm issuing equity, the required cost of capital. Or I guess we could call it the cost of capital. I guess cost of equity. Okay. This is the return of the firm is generating funds as raised from issuing stock. Okay. What does a Brownian motion process usually assume for B0? It's just equal to 0. Yeah. 0. What are some possible reasons why housing prices might be seasonal? So some reasons housing prices might be seasonal is because people are moving at different times, usually during the summer. A lot of families move during the summer because it aligns with school semesters. And also, for some weird reason, people don't like moving in the winter time, maybe because it's cold. Oh, also, leases on apartments actually usually end during the summer. Okay. How can we represent the relationship between compound interest are in the following? So we have number of compounding years, period is in year. M is equal to M as in period in years. V, principal bond, principal plus interest.
How many times did you go cue this shit?
So we could say that
Oh, I
the
did it once. I just think she was before.
principal plus interest of the bond is equal to the principal of the bond times 1 plus the actual compound interest rate divided by the number of compound periods. And then we raise that to the n times m. Compound periods. Okay, it's not bad. What is the instantaneous variance sigma squared of a Brownian motion process? Context of modeling stock prices. Oh, I think it's the underlying volatility of the asset price, and then we square it. The instantaneous variance is usually this standard deviation of returns for the asset return. The squared standard deviation? Squared standard deviation. Question mark. Alright. So this is something I have to come back to because I'm not too sure if it's a squared standard deviation of returns or if it's just the standard deviation of returns. Okay, so it's something to keep track of. Oh.
I think we shouldn't let them in.
Okay, that's fine. Oh, faster we let them in, faster we gotta go home.
What's the password?
Jensen's alpha is the idea of how much our asset is earning in excess of the market return and the risk-free rate. You can think of it as pure return compared to market and risk-free assets. Okay. Housing prices can be seasonal due to the fact that some families move during the winter. Sorry, don't move during the winter, maybe due to the cold seasoning or just psychological moods, but mostly move during the summertime. Apartment leases usually expire and are renewed in the summertime, but also the school semesters start in the fall. So the summertime involves a lot of families having the freedom to move.
Homie without the X
Doing.
like Romy.
Demand does have an impact on price. Price. Okay. How is an equity security like a fixed income perpetuity? And how is an equity security not like a fixed income perpetuity? So an equity security is like a fixed income perpetuity in the sense that it gives you fixed payments or growing payments over time. A fixed income perpetuity
I can get a 75.
is, okay, so it's going to be a fixed payment until the end of time, which is the idea of dividends. So equity securities, usually
I guess you're raising something like that.
companies have some type of free cash flow or free cash flow equity, and they can choose to pay that out or just keep it within the company as cash. And so
Are you double major or double degree? Double degree.
with the
Alright, did
fixed income
you take
perpetuity.
CoStar at Richmond?
Huh?
Did you
But
take
the-
CoStar at Richmond?
They haven't offered it yet. Why not?
Do you see that Amtrak is trying to extend like electrification at Richmond?
Yeah.
Do you see Ohio is
how is an equity
getting
security
hella
not like a fixed income
Amtrak now?
perpetuity? So maybe
Yeah.
the sense that
Like Columbus is getting its
once
Amtrak station
an equity
again, and like it's connecting
a
the
business
north and
gets
the south.
bought out, then
'Cause, like,
that
right now it's
means
literally just all in the north. And then
there
it's
is no
all
more
in the
fixed
south, all
income
in the south.
perpetuity. There is no more
Columbus
cash
all
flows,
stays within them.
but you get some type of principal payment, which can be thought of as getting your shares bought out. Our principal returns
I mean, yeah, we're basically we're taking the entire
can be
electrified.
acquired, and the acquisition price is like the return.
I asked Anushka if she wants to come with us.
Companies can be acquired, and the acquisition price is like the return of principal. What is the variance of the increments proportional to in the Brownian motion process? It's proportional to the change in time, because we calculated our variance as sigma squared times delta t, where delta t is the change in time, so it's directly proportional to how much time has changed. As time goes on, the variance. Okay, so this actually means with proportionality that as time goes on, the variance of the Brownian motion process gets higher. See this in the following graph, where as more time passes, the variance will bt plus delta t minus bt increases. Okay. What assumptions does the quoting growth model make? 1, that dividends increase at a constant rate. 2, that the expected return of a risky asset is constant. And 3, that the growth is less than the actual expected return. So the growth rate, this is all the information we have here. You guys are crazy. Yeah, I'm waiting for you guys. Alright.
Back up.
I can pack up in 2 seconds. G-bar is constant across time, expected. And there's generally a difference in higher from the risk-free rate and varies across stocks.
Have exam tomorrow.
Our bar is constant over time, so it's generally different and higher. So return is generally different and higher from the expected growth rate of dividends. G bar is constant across time. The end pass times 1 over G. What's going on?